Hey, welcome back, everybody, to today's Market Explained. I'm your host, Brian Kasal, and I'm here with my co-host, Mr. Chris Reardon. Chris, welcome to the podcast.
Thank you, Brian. Good afternoon, everyone. Glad to be here. Glad to talk a little bit about the markets and what's going on out there.
Excellent. And Chris, you're Director of Development at FourStar. That means you run everything to do with portfolios, recruiting, all the investments of the firm. You lead all the divisions that run all that, and that's really exciting stuff. Chris is the um, is the father of three young kids. I don't know how he does it, and he's also a native of Cleveland. Loves his Indians. Chris, welcome to the podcast.
Thank you, Brian. Glad to be here.
And I'm Brian Castle. I'm the CEO and founder of FourStar. I'm the advisor to insiders and CEOs. I'm the lead portfolio manager for the FourStar investment models as well. And I'm husband to the amazing Tripty and dad to Quinn and Evan, two wonderful young men. So that's our lineup for today. Chris. And by the way, folks, if you do see us and you can give us a 5 out of 5 on Apple iTunes, that would be great. They do all the ratings. So make sure you give us a good rating. The better ratings we get, the better off our rankings are in the system. So we're going to start off with our discussion of the markets, all the relationships, and then we're going to talk about the current market themes. We're going to talk about the economy and different aspects of it. And then at the end, we're going to start a new segment called Are You Kidding Me? There's a lot of interesting things that are going on that make no sense. So we're going to present some of the more absurd things that we see out there in the finance world, and political and finance world are all kind of connected. So, but Chris, why don't we start out with the markets? What do you see as far as the relationships between all the different segments of the market today?
Yeah, Brian, it's really interesting. So we've actually seen a little bit of a slowdown from the different asset classes, and I think it's the first time we've seen no change as far as the Dally points, the numbers overall. And we've seen this kind of for the last, I would say, 2 to 3 weeks. We've seen this almost kind of stalemate out really coming out of the 4th of July. So we still have international equities, and that's still holding that number one position, and that has 304 points, unchanged since the last podcast. With domestic equities still in that number two position at 301 points, and that's unchanged as well. So really still kind of a 1-2 right there as far as asset classes. Commodities is still in that third position and got a little bit of a rally from kind of the reignition of the volatility with the Iran conflict. So that's at 171 points. It bottomed about 140 points, but certainly a way far fall still from where it was maybe at the beginning of the year. And that's unchanged though since the last podcast. So commodities still holding that third position. Cash is in fourth, still at 121 tally points, unchanged. Currencies at 104 is in fifth, unchanged, and we still have fixed income dead last at 86 tally points, and that is unchanged. So it's been relatively stagnant, just from a general asset class perspective. Overall, I would say for the last probably about 3 weeks, you want to call it 2 to 3 weeks, really seen things kind of halt there for right now. Flipping over to the sectors, interesting kind of changes here. So energy still is leading the way. We saw them overtake technology the last podcast. They still are holding that number one position. They're up 32.27% year to date. Technology is still holding on to that number two position, albeit I would say barely. It's up 17.93% year to date, still holding that number two sector positioning. Industrials, though, is in that third spot, and they're up 17.29% year to date. So really challenging technology. So we could see technology really bump into that third position. And I would say even more importantly, right behind industrials in fourth is real estate, and that's up 16.8% year to date. So we really have a pretty close grouping, potentially even for the number two position, really. The 2, 3, and 4 spots are all, about 1% away, within 1%, I should say, of each other. So really tight cluster there in that 2, 3, 4 position. Energy has once again, just like we saw earlier in the year, we see a large gap there with energy. Consumer staples actually gained 1 spot. So it moved up into fifth there. It's up 13.88%. Materials dropped, so they swapped there. It's up 11.96%. And then healthcare has continued its run. Once again, you go back probably 2 to 3 months, and healthcare was the worst, if not one of the worst performing sectors. Now it's slowly moved up. It's up 9.60%. It overtook utilities to move up a spot there. Utilities dropped, and that's up 8.44%. Financials, and this is another interesting one. Both healthcare and financials, I would say, were both at one point the worst performers of the year. And now they're both actually starting to do pretty well. Is up 5.62% year to date. And then the bottom two, and these are the only two sectors that are negative year to date. Consumer discretionary, that's negative 3.03% year to date. And communication services, that's negative 4.44% year to date. So both of those have been negative. Those have been kind of the laggards recently, after we saw healthcare and financials really kind of come out of the cellar there and make their move upwards. So.
Well, Chris, it's really interesting as you point all this out. First of all, that international continues to be number one. And that just means obviously that the dollar's getting a little weaker, I think, obviously. And then how these sectors turn around. Energy was negative at one point, and it's rallied huge. And now the people don't realize how much there's a big movement within all those sectors. There's an index and whatever the index did, but there's huge divergence, 32% on the top one and -4 on the bottom one. That's almost a 40% difference between the top and the worst sector. It's really pretty crazy when you think about it.
Yeah, I mean, it certainly has been, I would say, a year of extremes to a degree. Whether we talk about extremes within the AI and tech world, extremes within energy and for oil, and the swings we've seen there, certainly has been a lot of volatility swings. Overall, we've seen oil come kind of full circle where it kind of got rocketing off to a start, really peeled all the way back, got overtaken by tech, and now it's kind of cycling back up again. So it has certainly been an odd year from that perspective. In past years, we've seen maybe tech kind of take off and kind of just take over and there's never really a catch up or a period there.
Mhm.
But we're certainly seeing a lot more jockeying and a lot more moving within the sectors, and even some sectors you haven't really seen as much, like real
Mhm.
estate. So that certainly materials has had moves here and there because that is in some ways commodity play, especially with the tariffs. But there are a lot of sectors we're seeing a lot more movement that we haven't really seen in a little bit.
Yeah. Well, it's really interesting. It's always a market of stocks, as we always say. But there's a whole lot of things that happen underneath the surface. You just hear what you hear on CNBC or Fox Business, and it really doesn't tell the story. This tells the story. So, um, yeah. So getting into current market themes, I mean, basically, markets have been pulled between the U.S. Iran Iraq war and then CapEx reckoning. The 500 S&P 500 drifted, 7,500 down roughly 1.4% over that window, about 2.4% early July, logging two straight weekly losses before Monday's flat finish. So the market's really kind of been selling off now. We're obviously having a sloppy time. Now NASDAQ fell 2.2% on July 23rd. It's the worst day since April. All those chip names that were so hot are not so hot anymore. And so we're seeing, people who are making tons of money in NVIDIA and AMD and Broadcom and Taiwan Semiconductor, those all sold off on fears on AI spending. Now there's gone from positive AI, Chris, to negative AI. Everyone's like, well, we're overdoing AI and we're spending too much money on AI. That's kind of what they think is happening. And volatility is climbing a little bit. So when the markets are going down and they're sloppy, that's when volatility goes up as people are moving around between different groups. Interestingly enough, then, the second quarter bank earnings came off starting in July 14th was very strong. Pharmaceuticals are doing better, and those groups were not doing well at the beginning of the year. Now we're seeing pharmaceuticals better and banks better. We managed to pivot in some of our portfolios to do that. we also managed to limit our risk in technology, and so that's benefiting us as well. And we just see these trends develop, and we're very focused on what the relative strength is. And then we'll also talk about our protection plan in a bit. We've gone to a protection level 1. But Chris, let's talk about the economics first.
Yeah, so I mean, I think as far as U.S. economics, the first thing to highlight is most importantly, the FOMC is meeting today, which is July 28th, and tomorrow. Tomorrow, there's the expectation, or the decision is going to be coming out tomorrow afternoon, I should say. And right now they're expected to kind of hold the target range 3.50 to 3.75. There was at one point, and there's been a lot of volatility swinging back and forth. There was at one point the prospect for even a rate hike here. We'll get into the inflation numbers have kind of cooled a little bit, which has helped, I think, ease some of those concerns. But I think right now the expectation is they're going to hold, kind of wait and see, and kind of. But I think one thing that will be interesting is the conference after that meeting, because after that, are they still penciling in maybe one cut? Is it a rate hike? Are they flat now? The market's going to do its own thing, but feeding off of that, what their expectations are, certainly could cause some volatility in the market. We'll just have to see.
Mm-hmm.
So flipping over to inflation, two cooler than expected reports. The June CPI fell 0.4% month over month. That's the largest drop since April 2020. And that pulled headline inflation down to 3.5% from May's 4.2%. So a huge drop there. I mean, it was expected to drop, and mostly because of the prices in gasoline. The energy index dropped 5.7%, could that component of it, and the gasoline fell roughly 10%. So, we know what the main driver was behind those CPIs. And so it wasn't that big of a surprise, but I think what the surprise was how steep the drop was there. Core inflation stayed sticky though. The May core CPI held at 2.9% and core PCE at 3.4%, which is a 3-year high. Shelter and services were the main persistent driver. The June PCE report, which is the production side, or the not the production side, that's the Fed's preferred rate, that's coming out, but that doesn't come out until after the FOMC meeting, so we probably won't see the impact of that till the next meeting. The June PPI, so this is the kind of production side of it, that confirmed the theme of the decline. So that was declining 0.3%, and the expectation was a flat. The annual rate eased from 5.5% or to 5.5% from 6. Goods prices fell 1.4%. That's the largest drop since July of 2022. So, once again, we've talked a little bit about this, but I mean, I think it is important to point out, especially from the producer side, even though when we think of gasoline prices and everything, we think about it when we go to the, fill up our cars, things like that. Gas and energy as a whole has an impact not only on, our lives, but also from producers, from the logistics, everything from there. So we do see that play out to all the items, raises, things like that. So that's really, I think, what really showcased in the PPI number there from that.
Yeah. So Chris, this is really strange. We've gone from a year beginning in 2026 where Trump was pushing for rate cuts, and looked like there were going to be rate cuts, get the economy going. And all of a sudden, inflation takes off, and they can't. But now we're seeing it slow down again. So our head's kind of spinning. But the market is still pricing in rate increases, isn't it? Yet it looks like we may not get them if inflation's going down.
Well, and I think that, yeah, I mean, it's a really tricky market, because it's kind of like the market where you can't really trust any of the existing data, because if you go back to, say, 2 months ago, you had maybe softer numbers, and then the whole thought process, the story, the narrative was, well, those aren't pricing in the price hike from the Iran attacks and war, all that. So then we saw those impact. Then we saw the truce. Now we're seeing this decline here. But then recently we've had a reignition of the war, and we've seen gas prices, jump up again. So it's kind of like it's really hard to trust these trailing numbers, and the Feds, they're not sitting there in a vacuum. They can understand that. So, these numbers here we're probably going to see, 2 months from now, a ignition of some of the inflation numbers just because of gas prices going up. So it's really hard to really get a trend because they're kind of, if you can imagine, zigzagging all over the place due to the energy prices. So we'll see though. It's a tough spot for the Fed. No doubt about that. What's the overarching trend? And even though, if you focus on the core, which excludes food and energy, which are volatile, as we can really plainly see, that is a big part of obviously our economy. And as I said, with the PPI, it really flows through everything. So, we'll have to see. I'll be curious what the Fed does, quite frankly.
Brian Castle. I'm the CEO and founder of FourStar Wealth Advisors. Now, we built FourStar on one simple belief that every client deserves clarity, confidence, and strategy built around their financial story. For over 40 years, we've guided clients through every market cycle, helping business owners, families, retirees protect what they built and then grow their holdings to meet the needs over their entire life for them and their family in the future. We are fiduciaries, not salespeople, and that means we sit on the same side of the table as you always. So from personalized portfolios to advanced tax and estate strategies, everything we do is about creating long-term freedom and peace of mind for our investing families. So if you're ready to align your wealth with your goals, visit fourstarwealth.com. Let's start building your future one smart decision at a time. Yeah, it is interesting. We have an election coming up, and this is not at all what the politicians wanted. They wanted to lower rates and get the economy going, and the economy is still doing pretty well, surprisingly, with inflation. But now inflation's slowing down. The housing market's kind of a mess. We'll talk about that in a minute. But all right, Chris. Well, what else about the consumer? How's the consumer doing?
Yeah, so switching over to consumer and kind of production, what's going on there? The consumers held up relatively well. June retail sales rose 0.2%, which was kind of roughly in line with expectations. Once you kind of take out the firmer, volatile categories, you keep in the firmer ones, it still is relatively kind of high, and we're still seeing that consumer hang in there. Still low 4.2% unemployment rate. And historically low jobless claims. So we continue to see the consumer willing to spend and willing to go out there. So as long as that keeps up, I think that's been kind of the underdog, the where people really have kind of underestimated, I think, the consumer. A lot of economists we're expecting maybe a decline or a recession. We never really saw it, and I think a lot of it was because the consumer held up. So, that's always a good sign if we continue to see that. I think the question a lot of economists ask is how much are they, holding up using credit, things like that? How long can they sustain that? So we'll have to see. But, as long as it keeps happening, we don't see that trail off. That's obviously a very good sign. Business investment looks soft outside of AI. AI is its own world. We'll talk about that in a second. But June durable goods orders rose just 0.4%. That was below expectations. But the AI infrastructure, that remains kind of the juggernaut, if you will, behind all this. Taiwan TSMC posted another blockbuster quarter. They announced an additional $100 billion in U.S. manufacturing investment. So we continue to see, and that's obviously very good. We've seen that kind of bringing back into the U.S. production, things like that. And then the dominant production side has still been the AI and the capital expenditures that you mentioned, Brian, earlier. And it's just the sheer scale of it. And I think that's what's really driving the volatility right now is in some ways absurd. Alphabet's now planning up to 205 billion of CapEx spending for AI in 2026. So not only is that an insane amount of money to be spending, but also, that's also going to feed into, electricity costs, which we've talked about on here, and the hardware costs. You got to build all that. I mean, these aren't in a vacuum. I had read an article about electrical engineers. How many electrical engineers do they need to build these data centers? And you could be some of these electrical engineers are getting paid half a million dollars to go and build these out because they don't have time to train them. They need these data centers now. And so it's really feeding into the economy and it's broadening it out. We're talking blue collar jobs. We're talking really helping that. So really interesting. I do think that's a big driver behind the economy. We'll see how if that holds up or not. We've certainly seen a little bit of skepticism right now in the market on that. Did they get kind of over their skis on it? But I think unlike the '08 crisis, if you will, there is a real asset behind it. And they are building these data centers, right? There's inputs happening here. So in some ways, in many ways, there's a little bit more of a grounding to it. So we'll see though. Switching
Yeah.
over to consumer sentiment, the University of Michigan's sentiment jumped to a preliminary 54.4 in July. That's the highest we've seen since February, up nearly 10% from June's 49.5. So we saw a big jump there. And that's the second straight 10% monthly gain. A lot of that was easing gas prices, things like that. It's still important to point out that's still a very historically low number. But obviously it's always promising and it's good to see it's moving in the right direction. We're seeing some nice gains there. So hopefully that continues.
Excellent. Well, good. Well, Chris, I follow the housing market pretty closely, and the mortgage rates have climbed to a 1-year high, and Freddie Mac's 30-year fix rose to 6.58%. Um, the average 15-year was about 5.96, and the 10-year yield hit a year-to-date high of 4.7. But June existing home sales fell 2.4% to 4.09 million annualized pace, even as the median price for all-time record of $440,600 per home. It's a fresh all-time high. Happened. It's quite striking. There's not a lot of activity, so there's not a lot of listings, so prices are going up. At the same time, new home sales were surprisingly stronger, rising 1.6%. So I guess, there's tends to be a bias of people buying a new home rather than an existing home. But the new home median price went down a little bit because the companies were looking to move inventory. So they leaned on incentives, price cuts, and different things to get their inventory moving. We still have a shortage, and depending on which real estate organization you talk to, it's either 4 million, 5 million, 7 million different units around the country. But we're not replacing those units to manage the growth rate of the population, even in the United States. So we still continue to have a backlog. That's compared to like during 2008 when there were 4 to 5 million too many homes, right? So now we've gone the exact opposite. We've absorbed all that, and now we're a shortage of homes, and it doesn't seem to be cleaning up. And with mortgage rates where they are, it still restricts things to happen. So rates have to probably go down to get the real estate market going. Doesn't look like that's going to happen like this month for sure, or anytime soon. The Fed's meeting here shortly, and I think nothing's going to happen. But it's a real issue. With if you have to pay $440,000 to get into a home. So we'll see how that develops, Chris. It's a continuing issue.
No, I mean, yeah, certainly. And it really kind of creates this to a degree, I don't say haves and have nots, but I mean, if you are, lucky enough to own or have your own home, I mean, you're certainly building a lot of wealth on that. But like you said, Brian, on the flip side, it's increasingly harder to be able to, get into owning your own home. I do think, if we can get a restabilization of commodities and the builders can go out there and build and kind of, target. I mean, we're talking about supply and demand, right? Capitalism. There certainly is a market there for kind of an entry level home. So I think one of the great things about capitalism is when you have this opportunity point there, someone will figure out a way. It might not be in a month, it might take a little bit, but it'll figure out a way and they'll kind of solve that solution. So,
Yeah.
um, it's exciting to see. So, last thing we'll wrap up real quick as far as the economy, the job market, wage growth stayed contained at 3.5% year over year in June. So, we're not seeing a sign of wage price spiral where it just continues to kind of rise and rise and feed into itself. So, 3.5 is still pretty good. Still kind of keeping pace with inflation, from that perspective, which is what you want to see. So that, once again, when you're looking at the Fed and what are they going to do, that's kind of the, there's different categories you're going to raise or you're going to hike that, plays into the factor that can be a little bit more patient, if you will. So, uh, flipping outside the US to the international markets, China released their Q2 GDP and it eased to 4.3%. That was actually down. It was weighed down by an 18% year over year drop in property investment and home prices. So they continue to have it kind of comes in and out of the limelight, but it's always an issue in China is their real estate market. It is a just huge issue continually there. If you guys remember way back when they had the big developer over there that was going to go bankrupt, that was going to cause all those issues. So that's always an issue. Exports were the bright spot. They surged to roughly 27% on AI-linked global demand. So that helped cushion it a little bit. But China's always an interesting economy because it is a state-driven economy. So it's kind of what is the CCP, the Chinese Communist Party, what do they want to invest in? How do they want to kind of allocate? Not necessarily a capitalistic, environment like the US. So staying on that front, the US-China trade tensions resurfaced, and we kind of saw this more broadly. The 10% blanket US tariffs introduced in February expired, I believe earlier this week. So markets are now factoring in potentially higher tariffs, things like that. Trade representatives have proposed a 12.5% tariff, but there's still some negotiating back and forth, things like that. So that's, once again, we want to see certainty. So hopefully things get resolved sooner rather than later from that front. But if we do see kind of the reignition of the tariffs and uncertainty there, we could see even more volatility kind of get spurred into the market right now.
Mm-hmm. Interesting. Well, let's talk a little bit about commodities, Chris. Oil's still dominating. So we round tripped it again. So crude spiked through mid-July on the reinstated blockade in the Straits of Hormuz. WTI, the West Texas Intermediate crude, topped $85 for the first time since June. And then Brent crude pushed above $100 a barrel before the U.S. and Iranian pause. And now we have another pause. And there's a 7% pullback in prices on July 27th, which was yesterday. So we're back down in the 80s, West Texas Intermediate crude, low 80s. So, even after, the movements all around, we still, show that oil prices are higher than they were at the beginning of the year. But, obviously this war is a big thing. There's an election coming up, and the president obviously wants to get the Republican House and Republican Senate reelected. And anytime oil prices go up, it seems like their poll numbers go down. Oil prices go down, people feel a little bit better. So maybe they're going to keep doing this. Maybe this is a strategy, Chris. I don't know. They're going to pause the Straits of Hormuz and pause the Iranian war for a period of time. Then they'll initiate it again, and just before the election, maybe they'll pause it again. I mean, who knows? Maybe this is a strategy. I don't know, but it's certainly not finishing the job in Iran. So we'll see what happens there. But I guess I'm kind of feeling like we have to get used to this kind of churning around of oil prices for a while until they finally get through the election, Chris. That's what I think is going to happen.
Yeah, I think the hard part there is you're at the mercy of Iran too. I hopefully if Iran hopefully don't, but if they get, that's what the administration or whoever wants to kind of try to play it. And if Iran gets wind of that, they can just say, all right, well, we don't want to pause and keep, hitting tankers and doing stuff like that and trying to put pressure on the US. So it'll be interesting. I mean, it's not the hard part, it's not entirely up to us, right? It's two sides.
Right? Exactly. Well, and then gold, gold's been relatively flat, and actually the S&P's outperformed gold since February about 30%. So, gold obviously did nothing for a long time, and then gold ran up to 4,000 a unit. And Bitcoin was real strong for a long time. So there's this interplay between all the kind of anti-assets that are not financial assets like gold and Bitcoin and other commodities like silver and precious metals. They tend to do better when the currencies don't do as well. So we're seeing that. And then from the page of the book that there's always something interesting in going on in commodities. The global sugar market is projected to have a deficit of 1.7 million tons. Of course, that means higher prices. Corn is up 10% in July after all the excessive heat. And we've had excessive heat in the Midwest and certainly all around the country. So that's all affecting prices. So there's always something interesting going on in commodities. If you're a nimble trader, there's something you can do there. So global sugar is up and corn is up. Um, a lot of interesting stuff there, Chris. So I guess that's kind of like all of our discussions on the economy. I guess the question is, what are we doing about all this, right? And now that the market's gotten a little sloppy, we have this four-star protection plan, Chris, that we've talked about many times on our show. And 85% of the time, the markets are going up in a normal fashion with little pullbacks and things like that. So most of the time, we're fully invested. But periodically, if things get really sloppy and the indicators start turning negative, the four-star protection plan kicks in. There are four signals by way of review for folks who have heard this before that will get us from fully invested all the way to maximum cash levels. The last time which we were was in April of 2025, just before the Trump tariff regime was announced and the markets tailed off. So we got lucky that our indicators were getting us into protection mode before that big market pullback. But anyway, we're in a similar position now. However, we got position number one, Chris, and as of today, we're going to be taking protection for the first level. We did that earlier this year too in the first quarter, but then it turned around and we got fully invested. So we're back to position number one, protection, just in case things keep going in the negative direction. And only, folks, about half the time that we begin protection do we go all the way to maximum protection. And my hope is, and our hope always is that we don't go to maximum protection. That means things are pretty bad. So we're bull market people. We like the bull market to go on. We like markets to go up. But if things get rough, we want to have some protection and not lose a lot of money in a bad market. That's what this is all about. So, Chris, looks like we're in position number one now, right?
Yeah, yeah. I mean, I think with the recent volatility, I don't think anyone would be necessarily surprised by it. I do think we just see, um, you know, with a lot of the factors there, to everything kind of ratcheting up, where, I think taking that first level of protection precaution, is prudent. And, we'll see if we get all the way to the full protection. We don't know. We're just going to go off the signals we're seeing but when we get those signals, it usually means that the market is entering maybe a little bit of extra volatility
Yes.
in there. So we'll see if see kind of if it plays out. Hopefully it doesn't. Hopefully we go right back to fully invested and
Yeah, that's certainly what we want. And just for clarification, all our growth-oriented portfolios that are comparable, like to the S&P 500, those are gone to protection. Also, the dividend stock portfolios that used to be compared to like the Dow 30 now are compared more clearly to the Russell 1000 value. Those have also gone to protection number one. However, international has not gone to protection. So international is ranked number one, and it's still on a buy signal. And there's some other smaller sectors as well, and small caps are doing pretty well also. So we have not gone to a protection level in small caps either. So that's kind of where we are. So we're in protection mode, folks, and that's what we're doing about it. And we hope the markets turn around, the economy, gets better, interest rates maybe go down a little bit. That would be great. So, Chris, we have a segment called What We See Out There, and we're going to add in a segment called Are You Kidding Me to the show here today. So, what do you have in What We See Out There?
So what we see out there, I mean, I think this was really interesting. The U.S. is backing a Madagascar rare earths project and a push to loosen China's grasp on kind of the supply chain. So it's it's in the, I'm going to probably butcher this pronunciation, so I apologize for this, but the Ampasindava ionic clay deposits, and they're rich in neodymium. I'm not going to even try to pronounce the rest, but I mean, I think it's really interesting. These are vital, obviously, minerals and deposits that are used for magnets, things like that, which are heavily used in defense, jets, missile applications, things like that. So we're starting to try to see the U.S. take more strategic stakes in this case, South Africa, things like that, to hopefully try to get back a little bit more of a grasp on some of the minerals markets from that front. And then two things that I'll mention kind of well, I guess before we go there, Brian, do you have anything from what you see out there?
No, you just mentioned the J&J sweeping deal on the lawsuits
Oh
and
yeah.
everything. So
Yeah, I
yeah.
forgot that. We got the I mean, this has been in the news for I think over a decade now at least. But you had the claims over the Johnson and Johnson talc, the baby powder, and the correlation to, I believe, ovarian cancer it was. So they finally have come to a resolution, or are at the very close of a resolution of, I think it's about $5.5 billion settlement claim. So that would be really big. I'm sure it would be a weight off of the Johnson and Johnson stock. Obviously, it's been going on for a decade, so I mean that's been factored in, but the unpredictability of that and the potential fallout. So we'll see, but certainly I'm sure the executives at Johnson and Johnson are happy to have that resolved.
Yes. Well, that's great. Now, Chris, let's talk about this new segment called Are You Kidding Me? So there's some absurd things that are going on in the investing markets. Let me start out with talking about SpaceX. So we just went through the largest IPO in history. Elon Musk, who, at various times thought that SpaceX might not even survive, because it's such an aggressive company. Well, it's done very, very well, north of $20 billion IPO. The stock was priced in the open market by $135 a share, opened in the 150s. With all the hype and all the excitement, it went over $200 a share. And I will say that all the way along the movement for the first week or so, we had investors who've had good feelings about SpaceX, and they called and they wanted to buy some shares in the open market just as a long-term investment play. And long term, I think it's going to be fine. But for those who are new to the IPO market, and admittedly, the IPO market has not been as robust as it has been back in the 90s, for example, when there were IPOs 3 or 4 a week, all kinds of IPOs. So maybe some people are new to IPOs, but IPOs get a little bit crazy in pricing sometimes. So they may run up in the meantime. But if they ever go below what the pricing was originally, then if you think about it, everybody has a loss in that stock. Now, FourStar and a lot of other investors managed to buy private shares in our diversified alternative fund, for full disclosure, and some investors bought shares at prices now the equivalent of 25, 35, $50 a share. They came out at 135, started trading in the 150s, like I said, and went over $200 a share. And we had people that bought stock all the way through that whole pricing time. But now the stock's trading at $115 a share. So it went all the way down past the 150 marker where everybody was trading. And then all the people that bought the stock in the IPO are underwater too. So if you think about it, in a big market year, when the market is up big, there's not a lot of stocks that are down. So there may be certain sectors that are down or whatever, but everybody's got a lot of gains. So then in the fourth quarter, everybody searches around for losses. Because if you can match your losses, if you have a loss and you can take out some of the gains, you pay less taxes. And so everybody's looking for tax loss stocks, and the stocks in an up year like this year so far that are down are the ones that get hit even more. So the stock went to as low as $107 a share. Let's hope SpaceX recovers. But SpaceX, after being the largest IPO in history and a very, very successful story, might be this year's tax loss stock, Chris. You got to be kidding me, but that's kind of where we are.
Yeah, I mean, I think as you said, it's a long term. If you're looked at it from a long term investment, I think you're in good shape. But for those of you that are trying to ride the momentum and, getting into that meme stocks, things like that,
Yeah.
it's a dangerous game to play, right? A lot of these are very volatile. So from
This
a long-term perspective, probably a good investment. Only time will tell, but short term, we're going to see a lot of volatility in that stock.
Well, and SpaceX is one of those names a lot of people know. A lot of other IPOs that aren't as well known, they most certainly end up being tax loss stocks if they go below the pricing level. In this case, is 135. So, but we'll see. Maybe it won't happen this badly to SpaceX, and maybe things will be different by the fall, or maybe the whole market will sell off, and then there'll be a lot of tax loss stocks, and it won't affect SpaceX as much. But we'll see over the next couple of months as we enter the fourth quarter. We're in the middle of the third quarter right now. Now, Chris, you had some other comments on GameStop and meme coin, if I remember right.
Yeah, I mean, I'll start off, funny enough, Elon Musk, is known for his meme coin, his Dogecoin that he came out and jokingly did. Well, they came out with a new, someone else entirely, not related to Elon, came out with a new meme coin whose entire pitch is just mocking the S&P 500. There's literally no reason behind this coin. It was called the SPX 6900. It bills itself as a joke rival to the S&P 500, and literally is nothing beyond just a joke. Yet this meme coin still jumped roughly 32% in a single week, and is now carrying a market cap of around 342 million, which is pretty ridiculous considering now an index parity meme coin is worth more than a lot of actual companies that actually, either make physical assets, things like that. So quite ridiculous. And then GameStop is continuing its bid for eBay. So GameStop, which is a company worth roughly $10 billion, is still trying to buy eBay, which is almost 5 times worth. It's worth about 48 billion. So previously they've made a $56 billion cash and stock deal that they were trying to partly fund with a $20 billion bridge loan from TD Bank. eBay rejected that offer, probably considering it's, GameStop's company is substantially smaller than eBay. Yet Ryan Cohen, who's the CEO of GameStop, has quietly amassed nearly 10% stake in eBay. And he told Bloomberg this week, we're coming for eBay one way or another. So they're going to try to take a minority stake and work it up. So interesting. We'll see. We'll see how that plays out. The strategy, I mean, it's not new. You have seen strategies like this as smaller companies have tried to overtake larger companies using leverage. But we'll see if it plays out. Obviously, GameStop was a meme stock in and of itself. It's since kind of come back a little bit, but we'll see. We'll see what plays out here.
Yes. Great. Well, we'll see. The joke to the S&P, that's funny. And GameStop just continues to be a story that why are they trying to buy a company 4 times their size? GameStop is barely alive as a company, even. Um,
Exactly.
it's funny. Now, two political stories that also affect economics a lot, and there's always a big connection between politics and economics. Our the head of the infectious disease group, Anthony Fauci, actually got released by Rand Paul his diary. That was part of the information they required when they had him testify about the things that happened during the pandemic. And if you read through that diary, there's a long list of bragging about how everyone loves him and how he was a superstar and everything else. Sounds like he was letting his ego get away from him. They also, it turns out, were not admitting what they were saying in private. They were saying things like, "Oh no, we have to shut down," and it was really, a wet market issue, and it wasn't, caused in a lab. Well, it turns out all that wasn't true. And if we had known that, and the effect on what happened to individuals, not everybody got COVID. Maybe we didn't even need shutdowns. Now, if we didn't need shutdowns, maybe the markets wouldn't have been down 37%, Chris, in 7 weeks, right? So we had one of the worst, quickest bear markets in history, 37% in 7 weeks. Maybe that wouldn't have happened. But everybody saw Anthony Fauci in a very angry way, testifying in Congress, insisting that everything was done for the right reasons and that he would never be political and that there was no lab leak. Now, of course, we know that's not true. Are you kidding me? They really did that. They really said all those things. Now he is protected by a pardon, although there is now talk that some of those pardons may not actually hold because of some of the other things that have happened. And the Biden people knew they were not being honest, which is why somebody went through and pardoned him. But then again, did Biden actually pardon him too? Because the pardon was done by AutoPen. Who actually had the AutoPen? So there's so many questions here, and that's really on the page of Are You Kidding Me? Hard to believe this whole story is playing out the way it does. From our perspective, it hurt a lot of people in the financial markets, and we don't know how that's going to play out. So we'll see. Tomorrow, by the time many of you hear this, this is Tuesday, the 28th. Fauci has to appear again before Rand Paul's committee. So we'll hear more about this tomorrow. So maybe by the time you hear this, this will have already happened and this will be in the news. Then also, Elon Musk, of course, joined in with the president to change some things as far as spending. There was lots of deficit spending that went on during the previous administration. So they went on the Doge committee to finally cut government spending. And, they say, man is on a quest for perpetual life, but we still haven't achieved it. But I think the only thing that's ever been equated to the closest thing to perpetual life is a government program where somebody's getting money. And that's kind of what happens. So if you are the one who would cut all those government programs, then you're evil for sure. And the USAID got cut, Medicare and Medicaid. It's been clear there's massive amounts of fraud in certain states. So the next group that gets in can always have a different opinion, and that's what they did. So the one group, the group that is on the far left in the Democratic Party is attacking Elon, and they're putting that on their platform now to go after him. And they're hoping to play well in the elections and demonize rich people. That's not the way America has always done it. That is the way it's done in other countries, where they do demonize rich people. They're skeptical of billionaires, but that's never been the case in America. But now there's a whole crowd of people, of democratic socialists, that are doing that. So are you kidding me? That's not an American thing. But it's really affecting a lot of things. It's affecting our deficits. It's affecting the economy. So when a lot of that money comes out of the economy, it can affect things as well. So we'll see how that plays out. And again, that's in the page of the book. Are you kidding me? The whole scenario took place here, but yet we're cutting spending and doing the right thing, so we're not abusing the taxpayers' money. So anyway, so Chris, that's our Are You Kidding Me segment for the day. I think that's it for us today, Chris, huh?
Yeah, I think that about covers it for this late July podcast.
Okay, well, thanks everybody. Again, we're in protection mode. Let's hope that doesn't continue. We look forward to another episode here in a couple weeks, and we wish everybody the best. We'll be back in a couple weeks with a new episode of Today's Market Explained. Thanks, everybody. Over and out.
Take care.
Bye-bye now.